back. Today we are finalizing our three-part series on the home buying process and mortgages. So if you haven't seen parts 1 or 2, please click the links in the description below. We cover home buying process and underwriting, 30-year, 15-year fixed, cover different ARM products, pros and cons and the differences. We also get into refinancing and PMI, private mortgage insurance, in series part 2, Before we start on part 3, if this is your first time here, if you haven't done so already, please like and subscribe to the channel at the bottom right. Okay, part 3, we're going to cover cash out refinancing, HELOCs, and home equity loans. These are all really good products to do a couple of different things. They all have different features that will either appeal or not appeal to you depending on your situation. So let's get started though with our first topic, cash out refi. Similar to a refinance, but also not similar. So in the regular refinance, you are taking out a brand new loan for the existing balance. Here, you are taking out a brand new loan on a cash out refi, but for a larger balance. And what this is allowing you to do is take some of the equity you have and take it out as a lump sum cash, and now you have a higher mortgage to pay off. So let me just use an example here because I think numbers will help a little bit better. Let's say you have a $200,000 mortgage on a home you bought 5 years ago, and it's now appraised at $400,000. Okay, you have $200,000 of equity, pretty awesome. So what this could potentially allow you to do is lenders are going to want you to have at least 20% equity or an 80% LTV, loan to value ratio. So if you do the math here, 20% on 400 is 80. So 80 off of 400 would be 320. So what we could have you do in this example is take your current $200,000 mortgage. You're now going to have a larger mortgage of 320, but you're going to get cash out a portion of this equity for the difference, 120,000. Do whatever you'd like with that. Now, most people will use this to pay off higher interest credit card debt, higher interest debt in general, student loans, car loans. Others will use that in a combination of maybe some home renovations or repairs. Use some of this money to, some of these projects are $5,000, $10,000, $20,000, right? New kitchens, bathrooms, maybe new landscaping, a new fence, new roof. These price tags are pretty high, and let's be honest, it's nice to think about wanting to do them, but when we see the estimate from the contractors, it gets a little bit more dicey. So this will allow you to feel a little bit more free and flexible in going through this process, and you can add a substantial amount of value. A $10,000 or $20,000 project could increase your home value depending on your neighborhood and the condition. Who knows, $30,000, $50,000. All depends, but you just kind of see the point of doing the cash out refi. Home equity line of credit. Consider, my best analogy here is like a credit card for your house. So in a credit card, you have a limit. When you want to spend money on something, use your credit card. You just pay for it. Home equity line of credit, you have a limit for a certain period of time. Let's call it 10 years. You'll have a limit of what you can draw from, a credit line. Now, if you want to do a project, if you want to pay some credit card debt right off the bat, if you want to wait a couple years to do a renovation project, you draw from this credit line whenever is needed for you. Typically, the repayment schedules here, you do like an interest only maybe for the draw period, so for the first 10 years, and then you work with the lender on the repayment schedule thereafter. A little bit more flexibility, I think, with the this and the cash out refi. Instead of getting a lump sum, you're kind of just able to know what your limit is and kind of draw on it when you need it. Put some stagger some different projects whenever it's convenient for you. Finally, we get into the home equity loan. So home equity loan is, I want to say similar. I mean, they're all kind of similar. You're really just adding another mortgage on your house. You're going to take a lump sum of cash out, part of your equity, but now you're going to owe a second mortgage on your house. Yes, it's going to be a lot smaller, but it's going to increase your monthly payment and kind of dent those cash flows. So if you have this, I feel like is probably best for maybe an urgent need on a large, high ticket item renovation or repair. If you need a new roof, insurance won't cover it. If you are looking to sell in the next couple months and you want to do a new kitchen, new bathrooms, whatever it may be, that home equity loan increases your payment, but if it's for a shorter period of time, maybe not so much, not so bad, and you can take care of some of those projects quickly, be done with it, move on, whatever you're trying to do and trying to accomplish with it. Whew. Okay, so those are our pieces. That finishes up here for our series. If you guys have any questions, please put them in the comments below. You can always contact us through the link in the description as well. Be happy to answer any questions for you, see how any of these may benefit your individual situation. Thank you so much for your time. Hope you found this useful and valuable. We look forward to seeing you on the next video.